Here is a building for sale in Oviedo, which is a small city next to Orlando, Florida, same county. Well, actually, no, Oviedo is actually a different county. But right away, the building looks a little newer, probably built in the 2005 time, roughly something like that. Looking at, you've got the pitched roof there, or not the pitched roof, but the parapet there. That looks really good. A lot of the retailers who are national, they like that a lot. Rooftop AC units. You know, the rooftop AC units, as a broker, as an owner, I have mixed feelings about that. I've seen buildings where the AC units are actually on the ground behind the building. And a part of me just believes that that is just better for the roof. I like it in the back of the building. I don't really like it so much on the roof. I think that when it's on the roof, you're penetrating the roof, and that just creates issues with rain and this and that. I've seen a lot of roof problems, but anyway, that's besides the point. Let's get on to reviewing the property. Right away, here we go. Here's Orlando, the downtown area. Oviedo's in the northeast. Price is just under 2 million for 7.75% cap rate. NOI is 153. You got 16% vacant there. Cash on cash return is over 9%. This OM is not very recent. I'm going over this simply to show you what I look for in a building. Okay, so unfortunately, it's not for sale right now. Please don't write to me and say, "Hey, where's it at? Can I buy it?" But this is what it was at the time when it was up for sale. 9,000 square feet, and hey, look at that, 2005, acre and a half. Trustco, Pizza Hut, Bernie's, Gourmet, To Go. I don't know what kind of restaurant that is, but it's a restaurant. These are the major tenants. There's like, for example, there's a liquor store there, but the liquor store is not getting any love in this little chart. So 31, 26, 19. That's a pretty big gap, but Trustco is an end cap. I'm gonna think that it's got a drive through, which can justify its high rate. You've got Pizza Hut at $26 a foot, which probably has a restaurant infrastructure where customers can eat on site, and they've got a full blown grease trap, a hood, and everything else. And spaces like that, they've got impact fees. Second gen restaurant spaces like a Pizza Hut or just fill in the blank restaurant, those locations are those spaces are very, very high demand. So whenever there's a vacancy there, it gets eaten up pretty quick. If you're out there looking to buy a building, if there's a second generation restaurant there, there is a lot of value for that type of space. So you would usually be able to rent that space for a little bit higher than market. And in some cases, tenants will give you key money for it. They'll actually pay you, the landlord, to take over that space, because now they can actually walk into a space and spend 50 grand and have a, assuming like a 2,000 square foot space, they can spend 50 grand and open up shop versus having to spend $250,000 to build out the whole kitchen infrastructure, permits, the time, the risk, things like that. 1 mile radius, 5,700. I'm not crazy about that. I usually like to see at least 10,000. 3 mile, 5 mile, that's okay. 3 mile and 5 mile, that's great. But in terms of like a shopping center like this one, that 1 mile number above 10,000 is good. 8,000 maybe if it's like a very high income area, but that five is a little on the lighter side. Now, with that said, at the time of this property being for sale, it was 27% growing annually. So that's definitely a plus, and that must be considered. But moving on. What do we got here? This is a bunch of little details that if you want to read it, you can pause the video, but I'm going to go ahead and move on though. Here are surrounding tenants and businesses and just landmarks around the area. Sometimes whenever I see whenever you see a chart like this or a map like this, but then it's not followed by a map like this, meaning a close up of the street, this one here is kind of there to trick the buyer slash investor and say, hey, look at all these great landmarks around us. But really, the reason why they're not providing something super close is because there's nothing super close. But fortunately for this one, there's actually a bunch of retail nearby. And a lot of times looking at the retail nearby, you can kind of tell what kind of market it is. Like, for example, here at Caddy Corner, you've got a Publix shopping center, which Publix is a is the shop. It's the grocery store in the Florida market, in Georgia, and some other states that they're in. But when there's a Publix nearby, you can more or less bank on the fact that it's a strong market with population growth, income demographics, that kind of thing. Like it's a good area to be in. There are times where you'll see Publix go into certain markets where uh, they're um, they're kind of like first to market, right? Like they're willing to. I heard this a while ago, and I actually do see it here and there. They're willing to go to a market and lose money for a short period of time, a few years, just to be the first to market, and just to be there while the area is still developing. Like for example, just case to point, nearby where I live, I actually know that there's a Publix opening up in this particular area where there's not much going on there yet, but they are planning a master plan that's going to have like 6,000 homes there. So Publix will go there first, and knowing whenever there's a shopping center or a strip center for sale and there's a Publix nearby, it's always worth a look. Always worth a look. You're more or less a shadow anchor at this point. Not truly a super shadow anchor, because shadow anchor by definition, you're literally across the street or next to them or sharing the same parcel. Uh, but um, but this is quasi shopping center. If I was a broker selling this, I would call it a shadow anchor, and then buyers will debate me on it and they'll dispute it. But that's something that's up for discussion, right? Because are there people visiting this shopping center that maybe would have just come from Publix? Absolutely, absolutely. So anyway, here's another shot of it. Something interesting too when you're looking at it. Oh, look at that. There's actually a Winn-Dixie on this side too. So that just shows the neighborhood growth in the area. Um, what I was going to mention was that if you look at on this side, there's a lot of retail over here, right? You're looking at looks very busy, but then you go to this map on the another angle, and there's just nothing but trees over there. So that's a little disheartening. But moving on. Here is the financial summary. You've got price, cap rate, NOI, cash on cash, the 16% vacant we talked about. I'm looking up here right now. 16% vacant. Vacancies are always good, assuming that the price they're asking for and the cap rate is based on actual income, meaning that you can come in there and fill in that 16% and make a little bit of extra money. Base rent, reimbursements, gross revenue, expenses. So you've got total expenses of 92,000, but reimbursements are only 69,000. See, that's very interesting. Gross revenue is that. You've got NOI 153, proposed debt. The $63,000 of reimbursement and the total expense is 92. Normally, I would say, okay, perhaps that's the 16% there, right? But let's do some quick math here. If you do, what's the math we're looking at? We're looking at 92 minus 69, right? 92 minus 69. That puts it at 23,000. 23,000 divided into, let me see it. Let's do, oh, sorry about that. 23,000 divided into 92. That's 25%. 25% is the uncollectible reimbursements, but you got 16% vacancy. That tells me that someone has a cap on their expenses. Something is not adding up. So let's find out why. We've got structural reserves, management, CAM, insurance, real estate taxes. So let me see your debt coverage. Oh yeah, as you can tell, interest rates 4.85. That was, this was definitely not anytime recent. But again, just doing the exercise here to show you how I review properties. We still got to find out why there's a 25% discrepancy of the reimbursements, right? So we've got 15.56 vacant, Trustco, rates are 26, 18, 19, 17, and 31. So clearly you've got a 17, 19, and 18. 26 here. So it looks like the national tenants, Pizza Hut or the end caps, right? Pizza Hut and Trustco, they're paying the 26 and 31. Those are going to be on the higher side of things. Actually, let's look at the reimbursement. Full prorata, vacant, full prorata, full prorata, full prorata. Cam tax insurance, management, 15% admin fee. Yeah, that's interesting. On this one, see, normally there would be, because there's that 25% delta, really, if there's 16% vacant and 25% delta, you've got 9% delta, really. So you got to find where that 9% is. And in this case, everyone is showing pro rata. Yeah, everyone's paying their fair share, CAM tax and insurance management. I like how they actually say that the tenants are paying CAM tax insurance management. And in this case, they're paying 15% admin fees as well, which is a nice little cherry on top. Yeah, very interesting that we can't find that. Oh, see, remember earlier when we were talking about Trustco, they might have a drive-through. They certainly do. That's that drive-through right there. So if they were to move out, you could definitely recapture that $31 a square foot there. This end cap here being $26. Is that what it was? Yeah, 26 bucks a foot. Um, I don't know. That's tough. I mean, I think that you could probably get. I mean, if everyone else is in the high teens, I would probably underwrite it at around the 22 to 24 number, maybe 24. I think 26 a little strong. They might have bought that rate, meaning that they might have paid a lot of TI in order to get there. I think that's what happened with that Pizza Hut there. The owner just said, "Hey, here's like everything you want," because having the Pizza Hut there is going to really help the valuation, right? Because now you got a national credit tenant. But the thing is that maybe they wanted to pay something low. Maybe they wanted to pay that 22 bucks a foot. But the landlord was like, "Hey, we'll give you X amount of dollars. How about you pay 26?" And Pizza Hut probably said, "Okay." So although they're paying that and that's great, I would look at it and say, "Hey, if Pizza Hut was to move out, what would a new tenant moving in there pay?" And then based on that question, I would probably say 24, maybe a little less, but let's just call it 24. And then I would readjust the NOI for that space, which would then affect the NOI for the building, and then and then buy the building based on that price. Readjusting camp like readjusting the base rates on buildings and making an offer appropriately. That's that's a high level move. I've seen guys do that. And for example, there was a building I saw for sale the other day. There were three tenants there. Tenant number one was paying $32 a foot. Tenant number two was paying $34 a foot. Tenant three, $65 a foot. What do you think is going to happen there? Any buyer looking at that building has been for sale for like a year. Any buyer buying that is going to say, "Hey, why is this guy paying $65 a foot? And he's the biggest space. He's like the anchor of the space of the building. He's paying way too high. He's paying double market." So any buyer going in there is going to readjust that $65, or any buyer who is going to buy that has to come in and readjust that down in order to make sense of it. Now, if you were the seller, you could definitely push and get higher rates. Like, let's say the seller who was actually developing that property and actually leasing it up, whether the developer or just the buyer or owner are releasing the building, right? If you have got a vacancy, you can always buy your rate and push the rates high and get the tenant to go in there. But you got to be able to ask the question, is that a replaceable rate? If that tenant moves out down the line, can you put a new tenant in at that same rate roughly? And the reason why is that maybe not so much for you, but when you go to sell it, you got to be able to defend it. You got to be able to say, "Hey, based on these comps, based on where the market's at, based on these 6,000 homes coming in the area, you can ask for a higher rate." So as long as you can defend that conversation, then as the seller, as the broker, go for it, ask for it. But if you can't support that number, then you got no reason asking for it. And if you're asking for it, you might run into some people who just really love the real estate, or maybe they just don't know what they're doing. But at the end of the day, if you want to take that medium risk approach, go ahead and ask for that higher rate. Buy that rate if you have to. But the thing is that be able to defend it should you get asked upon it, whether it's from a buyer if you're trying to sell it, or maybe the lender. There's some lenders that I've seen look at deals like that where you've got a 30, 32, 35, and a $65 a foot. They'll say, "Hey, this deal is too risky. We're not going to lend it to you. And if we do, it's going to be a super low LTV, maybe even a higher interest rate due to the risk," right? So you're just setting yourself up for trouble if you go down that route. So moving on now. Um, I see that's next door to Taco Bell, next door to AutoZone. And the building's nice. This is a nice building. It's a very nice building. Here you've got some tenant information pages that will tell you about the tenant, bank, national credit. You see, once again, they're really pushing and highlighting the fact that they've got a Trustco here and a Pizza Hut. They're not talking about the liquor store and Bernie's and whatnot. They kind of don't care about those tenants, which is okay. It's fair. When you're brokering a deal and you're trying to highlight its greatness, you want to go ahead and push those national tenants. Another page to show how awesome Orlando is and Oviedo is. Here's the final page, which is just demographics in the area. We already talked about the local population being only 7,000 or so in a mile. Let me see, households 2,300 within a mile, which is very light. Predominantly white area. Average household income, it's 92,000. Median is 75, which is it's climbing up there, but then definitely not. I wouldn't call it high income. compared to other parts of Orlando. But that's more or less the overview of this property. It's a good property. There's nothing wrong with it. I would just say that make sure you try to find out what that discrepancy is. The you got 25% of uncollected reimbursements and a 16% vacancy, leaving a 9% delta. Like figure out where that 9% is, because it's just not being collected. Where's that page at? Yeah, right here. It's just not being collected. So yeah, watch out for those things. And let me see here. Is it here? 2018 expenses. Yeah, this is clearly from years ago, from 5 years ago or so. But still, 5 years ago, 5 years from now, 10 years ago, 10 years from now, looking at these buildings, it's the same way, same formula, same eyes. It's just different numbers and a different time. Okay. Thanks for watching. If you have questions, feel free to let me know. Thank you.